let's welcome on board Umesh Revankar, VC and MD at Shriram Transport Finance, joining in the show right now. Mr. Revankar, with the onset of CV cycle, demand for CV financing has clearly improved in the last few months. Do you expect this kind of momentum to sustain and the demand scenario for both used CV and new CV space also to continue?
I strongly believe this demand will sustain because in every CV cycle, when it bounces back, it normally happens after 3 years of the previous peak, and it started picking up, and maybe third, fourth year or fifth year, it peaks again. So that's what we have seen in the last 3 or 4 cycle. We have seen this happening in 2012, then again 2016, 17, and it reached a peak in the 18. 1 million vehicles were sold, and it came down to around 550,000 unit previous year, and last year it went up to around 720,000. So still it has long way to go to 1 million mark. So I believe the demand will be continuous for next couple of years. And also other reason is the infrastructure spent by the government is strong. There is a good demand from the real estate market. There is a good demand from the rural market. So rural market demand is really creating a bigger demand for used vehicle, and that will indirectly lead to new vehicle demand. So in spite of the vehicle prices going up, in spite of the fuel price going up, because economy is growing, there is a demand for vehicles, and we believe it will sustain for maybe 3 to 4 years from now.
Good morning, this is Nantara joining in. So yes, commodity price inflation had to be dealt with. Mercifully, that's starting to soften. But now there is quantitative tightening. Interest rates are going up. How is that going to impact demand? Is that a challenge for CV financiers, or are there others?
I believe the interest rate is very small component in the overall purchase cost, because when the price goes up steeply, in the last 2 years, we have seen the new vehicle prices going up by around 30-35%, because one is the BS6 technology change, and second one is because of the input cost like steel price going up. These are the 2 main reasons for vehicle price going up. Then automatically, the focus is more on the cost of acquisition rather than the interest rate. So the interest rate becomes a smaller component. So even if the interest rate goes up by around 50 basis to 100 basis point, it will not make a big difference in purchasing decision, as long as there is enough business, economy is growing, and if there is enough absorption in the economy. So the interest rate will not make a big difference. Of course, the interest rate goes up steeply further up, there could be some disadvantage, or maybe there may not be sufficient interest in going for bigger ticket vehicle. But smaller ticket vehicle, which is essential for normal transportation, there will be definitely demand.
Your NIMs came in at what? I'm looking at the numbers, 6.91% as against 6.96%. That's a comparison of quarter on quarter. How do you expect NIMs to trend in the short term?
See, we are in a very niche segment. We can easily pass on the increased cost of borrowing to our customers. So we have already increased our lending rate by around 25 basis points. So we should be able to maintain a healthy net interest margin of around 7%. We believe 7% is the ideal margin in our lending activity. So it has come down from 6.96 to 6.91. It is a minor adjustment, and it will definitely go back to around the 7% NIM, and it will continue to remain at that level, is what we believe, because interest rate increase in interest rate in borrowing will not really have a big challenge on our maintaining the spread.
You know, your NIMs in the first quarter stood at about 6.91 versus 6.96% sequentially. Where is that we can expect them to trend in the short to medium term?
See, we have provided. If you go back, we had quickly provided around 2,800 crores as a COVID provisioning, which was additional provisioning than the normal provisioning for COVID-related challenges. Out of that, we had used around 800 crores in the previous quarter, in the fourth quarter of previous year. And again, this year, we have used around 216 crores. And we have another 1,800 crores left. We should be able to utilize most of them either for writing off or writing back, depending upon the various asset classes. So we feel that we have adequate or maybe more conservative look on the overall provisioning. And therefore, we are reasonably covered and we don't see anticipating any kind of a, what you call surprise in the asset quality.
Right. Mr. Revankar, thank you as always for taking the time out, and I'm glad that you could also throw in your asset quality trends going forward.